Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler. Talking money and investing. You know, I was just looking at a couple things out there. I think it's interesting if you look at how some of the metaphors and the ways of explaining these particular topics, how some of the academics, the great academics of the past have explained some of the things that I talk about here on the show all the time. I had a friend of mine who used to put it this way. He said, well, I'll do this. Borrow somebody else's credibility. And this is my early days of starting this show that always stuck in my mind. You know, I have lots of degrees. You know, I can't even remember half of them all the time. I mean, chartered financial consultant, chartered life underwriter, training counsel fellow, accredited asset management specialist. I actually have to pull out a business card to even remember. Chartered advisor for senior living, retirement income certified professional, wealth management certified professional. So a lot of financial related degrees. I like, we kiddingly say around here, I like collecting designations on investing and financial planning. But, even still, you look at the giants out there and you really have to defer to some of these people that have dedicated their entire lives and even won Nobel Prizes for the research regarding investing. And one of those guys is Harry Markowitz. And, he talks a little bit about this topic of, why it's so hard to beat markets, why it's so hard to get higher returns. And, there are huge investment managers out there. And the reason I bring this up, there is one in particular that comes to mind that I see advertising a lot. We do what, we do well when you do well. And, and they'll have, we act as a fiduciary all the time and we don't receive commissions or anything like that. And, it's all great. The messaging is great. But, when you look at the way they manage portfolios, you'll see individual stocks, individual companies being held in the portfolio. And you go, well, wait a minute. And they'll be trading those stocks. Well, why would they be trading those stocks inside the portfolio on a month by month, year by year basis? Well, they would be trading them around because they think what they're selling is going to go down and what they're buying to replace it with is going to go up. That's why investment managers do that. And it's what I've railed against for 25 years on this show. But why doesn't it work? Well, Markowitz explains that. And this is a guy that won the Nobel Prize in economics in 1990. Here's how he explains it.
Let me illustrate with a particular inefficiency and then see what happened to that particular inefficiency. There was a time when if you knew what you were doing, you could make more money at index arbitrage than you should have been able to make in a perfect market. That's not true anymore. The reason is, little by little, people went in and figured out the game and went.
Okay, that may be way, way above your pay grade. So the idea behind arbitrage in general, and sometimes you'll see this kind of thing with ETFs and exchange traded funds. You'll have a basket of goods, let's say. And then you'll have this basket of goods and somebody will come up with a fund that is based on that basket of goods, what the value of that basket of goods is. Now, if you look at the basket of goods, and let's say that the basket of goods is worth $10, let's say. And then you have the fund that it's based on, it's being traded out in the marketplace by investors. And it's worth $10.50. Let's say that the ETF is worth $10.50, and I'm just making up numbers just so you get the concept. Let's say it's worth $10.50. Well, what will happen is you go, they're not in concert with each other. So what will happen is you will get rid of, you'll sell the ETF and you'll buy the basket of goods. and because they're not in concert with each other, and they're not selling, they're not in equality with each other. They're not in concert with each other. So what you're doing is you're getting rid of one. And when you get rid of one, you drive down the price of that thing that you're selling, because, when you have lack of demand, you're selling something, prices tend to go down. And then you're buying something else, which tends to drive the price of that up. Well, what happens is you get them into parity. And when you get them back in a parity, you have squeezed out the inefficiency. And that's what he's referring to right there. So that's what he's talking about. The arbitrage used to work. Why? Because you didn't have enough trading for that inefficiency to be squeezed out.
And squeezed out that source of inefficiency. So there are sometimes sources of inefficiency that people can exploit, but as they do, they drive away that inefficiency.
And that's exactly right. Now, this, as I use the example I used on this years and years ago, I was doing a video about this particular topic. And there was a major network, and the major network was talking about how the stock market was rigged. And they were interviewing these guys who were they were playing one over on the network. Because basically, I said, these guys are taking them for a ride, because the people in the media didn't understand the concept, and they thought that they were unearthing some big scandal. and the point that I made was that the markets were becoming more and more efficient as time was going on. And the reason was because you had ease of information access, and the ability to trade has become easier and easier every year. And the way I illustrated it in my video is I actually walked through how those inefficient, and I had a great graph, and it was walking through how the costs of investing had been coming down. And it was actually the opposite of what they were trying to make the point of on there. But the inefficiencies, that was what Adam Smith said in the 1700s. He said, markets will work, and they will become even more efficient as time goes on with ease of access to information and the ability to trade. Because then what will happen is buyers and sellers will come together, and you won't be able to take advantage of each other. And the other way that was actually shown, I'll share it with you next hour. It's pretty interesting regarding computerized trading. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. And welcome to the Investor Coaching Show. Paul Winkler here, talking money and investing. So I've been talking about a couple of basics on how markets work. Let me apply this for a real quick second. So when we talk about, when I'm looking at what to invest in, and it amazes me, I'll talk on here and somebody will tell me that they've heard this show, and then they'll tell me what they're doing investing-wise, and I'm going, well, you're doing just the opposite of what I talk about on the show, which is you're actually engaging in trying to figure out which stocks are going to be better than others. And, what companies that you really favor, companies you think are going to do well, and you're investing in them. Why? And they'll go, well, I think it's going to do really, really well. Well, why do you think it's going to do well? Because they got great products, and I like their products. So, okay, that's really good and everything. Do you think you're the only person that thinks that they have a great product? And they'll go, well, no, not necessarily. Well, so if you think that they got great products and you're going to go buy their stock, you're going to go buy it off of somebody that has the company right now. And why do you think they bought it? Well, because they thought it was great. Well, yeah, exactly. And if they're going to sell it because they think it's still a great company, but they just need money because they're going to buy a car, or they're going to, they're retired and they're living off of their savings, do you think that they're going to sell it to you for a price that is beneath what it's really worth based on all that great information and how good the company is? And so it would be, well, no, that wouldn't make sense. Would you do that? If you own that if you own that company right now, would you sell it for, a song and a dance? Well, no, of course I wouldn't. No. So you're assuming somebody on the other side of the trade is not as well informed, or that they're not as smart as you. Well, I guess kinda. Well, who are you actually buying it from? I never really thought about that. You're buying it from a market maker. Their job is to do nothing but buy and sell that stock all day long. So when you go and buy that company that you think is really good, you're buying it off of somebody that holds an inventory in it. They don't want to get ripped off. They don't want to sell it for less than what it's worth. But that's what you're assuming when you go and do that. Now, we talked a little bit about, market efficiencies just a second ago, and I was playing that clip, from Markowitz, the Nobel Prize winner from 1990. And one of the things he talked about is arbitrage, and how, with arbitrage, market inefficiencies are squeezed out. And I explained what that meant in the last hour. Now, one of the things that was talked about on this special on one of the network stations, they were, it was this big, they were going to go and expose the industry, and they were going to expose, how bad the stock market and how rigged it was and all of this stuff. Well, one of the things that I talked about was how if you go to Manhattan, they actually have computers, they take buildings and they hollow out these buildings. So you got Manhattan, lower Manhattan is where Wall Street is. And, you can go progressively further and further north, right? And you're getting further away from where the trading is actually taking place. And one of the things they actually, in a documentary I saw and talked a little bit about years and years ago, they were talking about how companies were coming in and they were hollowing out buildings. And you might have let's say a computer system in northern Manhattan, and they would be doing trades on stocks, and they would be doing this arbitrage process where they were trying to squeeze out inefficiencies. And you would have somebody who would come in and they would buy a building in Midtown Manhattan. So they would be just a touch closer to Wall Street than their competitor. And the reason they did that is if they could get just a microsecond, just an advantage over their competitor in northern Manhattan, that they could actually squeeze out the inefficiency faster, and they would have an advantage. And they could get a fraction of a penny difference in terms of, maybe pricing. And they could actually make money doing that. And that's just how competitive it really was. Now, what happened is these guys that were on this special years and years ago, what they were doing was setting up a competing trading platform to the regular trading platforms for stocks of the time. And the reason that they were doing it was because they wanted, and the reason they said they were doing it, let me put it this way. They said computerized trading was taking advantage of investors. And they had, quotes from mutual fund companies that were angry about the computerized trading. And they say, they're coming in and they're trading this out from under us and blah, blah, blah. And they, they're buying these stocks. The computers are buying them. And then what they're doing is they're taking advantage of us regular traders. And my point, and they were talking about huge mutual fund companies complaining about this. And my point was, you guys are trying to pick stocks, which we know doesn't work. And you're just mad because the computers are making markets even more efficient, making stock picking even dumber. and I was I scream at the TV, I'll watch TV and I'll just scream at the TV and go, this is crazy. This is stupid. I can't believe you guys are doing this. But what these guys are doing is they're setting up a trading platform that was not going to be in any way set up with computerized trading. And I thought, isn't that convenient? They could create demand to go to their platform. Now, why would that be good for them? Well, now you have a new group of people that are buying and selling stocks on your non-computerized platform. and you make more money. You can attract business that way. Now, who benefits most? The folks that were actually running the trading platform. And you see this now, even today, you still see it, where you'll have these firms that will advertise to younger people, we've got free trades. We'll do all the trading for you for nothing. You have zero commission trades and zero cost and blah, blah, blah. And you go, how are you guys doing that? Well, they're directing trades to market makers that pay them more. They make money. Don't kid yourself. They are not running charities. They're finding other ways to make money off of you. You just don't see it. It was like I was talking about last week. I was talking about that those funds that were engaging in leverage and the management fees. I don't even remember. It was like 30, 40, 50%, something crazy. The management fees were huge in a given year on some of these funds. And it was because of the trading costs that you were actually incurring, and they were not part of the management fees. And, people don't recognize that this is what's happening. Because quite often, they just look at the management fee. Oh, the management fee's low. And they think that's it. And my point has always been, no, you have to look way deeper than that. I'll have funds that I'll use for our clientele, and they'll have a little bit higher management fee than a competing firm, a competing fund company that we could use. It's not that they're competing with us. They're just funds that we don't use. And you'll see, in many cases, you'll see these funds will have higher returns and they have higher management fees. And you go, wait, what's going on here? And I'll have to explain, look, there's more to the expenses than what meets the eye. Yeah, Jim and I were talking about that. Now, I just remembered the conversation Jim Wood and I were talking about that implicit, because Jim was talking about implicit versus explicit expenses. Explicit is what you can see. Implicit is what you can't see. Bid offer spread costs. What do they do with the revenue from, when you're doing securities lending, what are they doing with that? There are all kinds of expense commissions. I have to explain that mutual funds pay commissions. Did you know that? A lot of people don't realize that they're actually getting commissions inside their funds because of the way things are traded. And, there might be, shelf space arrangement. And, there are all kinds of little expenses that you may not even be aware of in the investing process. So just recognize that sometimes maybe there's more than meets the eye when it comes to this stuff. And I am really quick to point out that, there is a lot to know, and you've got to really, really watch out. And, when we're looking at investing, certain things that we're looking at, correlations. A lot of times you never hear people talk about that. When I'm investing, I'm looking for things that are not necessarily moving with each other. Unfortunately, what happens, people choose mutual funds based on past performance. I look through a list of funds at work and I go, this fund had this return, this one had that return, this one wasn't so good, I don't want to buy that fund. And then they'll buy this one over here. And what you're doing is you're appealing to your sense of, I want to go toward pleasure, I want to go away from pain. Well, when you're investing properly, when you're looking at what we want to do is make sure that we don't have things that all move with each other. It's a basic tenet of investing, diversification. But how do you measure it? You measure it using correlations. If I have two things that have a positive one correlation, they move together. When one zigs, the other one zigs with it. Then you've got a problem. You don't have diversification. I want things that move in dissimilar fashion. Matter of fact, that is literally what Markowitz talked a lot about, and that's what he won the Nobel Prize on, is how to put together portfolios based on that. And here's Markowitz himself. Now, he's since passed, but this was a piece of audio of him talking about what the idea behind correlations were.
In order to diversify properly, you not only need lots of securities or lots of asset classes, but you need ones which are not too correlated, whose returns don't go up and down together too much. So that makes the problem of diversification a little complicated, because you have to find combinations which will fit together properly so that they don't go up and down together.
And that's as simple. It's just really simple that way. And, what does that? Well, typically what we want are, very big companies and very, very small companies. And when we find that when we have a portfolio of very, very big companies and very, very small companies, we tend to get a little bit of that dissimilar price movement. And we also have value versus growth, international versus U.S. You'll have these things that move in dissimilar fashion, and that's what reduces the overall risk. That's what can reduce that risk of that portfolio. Now, why is that an issue? Well, most people do their default choices at work. When you do a default choice and you don't recognize that they're not diversifying in this manner, you don't recognize it typically until it's too late. And that is something that I've been railing a lot about lately, because I want people to get that this is not what you hear being talked about. Yeah, we're diversified. We have you on a lot of different funds. And then what I'll typically do is I'll take the list of funds that somebody actually has and I'll show, hey, all of them own the same stocks. They all own Microsoft. They all own Nvidia. They all own Apple. They all own Walmart. You notice that they all own the same stuff. You have broken that rule of investing. This is why it's so critical. The very first time that I'll sit down with somebody, or any of our people sit down with somebody, this is the first thing we look at. What are the rules of investing as you know them? Buy low, sell high. Buy and hang on to things, diversify the portfolio. When we see that those rules are being broken, that's when we go, oh my goodness, we've got a problem here. That is when we're motivated to change our behavior. But typically not until we have that cognitive dissonance in that I'm doing this, but I believe this. Typically, we won't start to change the behavior until we see for ourselves that we're breaking those rules. In fact, I was talking to a young guy this week, and we were just talking about, talking to friends, about investing. And I says, you know what, in the way I've always approached people about investing is I'm going to educate you first. And you may want me to fast walk it. You may want me to go quicker because you're just like, let's get this done. Let's do this fast. And I'm going, no, I want you to get this, because the more you get what you're doing, what am I doing? I'm diversifying. How? How do I know I'm diversifying? How do I measure that? How do I know that I'm keeping costs down? What are the costs of the investing? Why am I doing it? What is the effect of investing in this manner? And what should I expect? What will markets do? If I think that they're always going to go up, when they go down, then all of a sudden now I'm like, oh my gosh, I'm doing the wrong thing. I'm scared, and I'll jump out. And then I sell, and then they go back up, and I'm not in there when they go back up, and I've got a problem. So what we want to do is we want to make sure we know, what am I doing? Why am I doing it? What should I expect? What are the costs? What are all the costs? Not just the visible costs. What are the hidden costs of investing? Very, very critical. And that's why we spend so much time on that. But I said, slow walk it. Because he's just like, how do I talk to people about this? I said, just don't get in a hurry. Because if people sense, that you have their best interest at heart, then they'll be a lot more inclined to listen. But if you're sitting there thinking about you, I've always told my staff this, don't think about you. Do not think about you and what you need. Totally focus on the client, their retirement, what they're trying to do, what their goals are, and you're going to be fine. That's always been my philosophy. You're going to be fine. But spend time, because how few people actually spend any time educating investors. And that is why the returns that our investors have gotten have been so bad. Matter of fact, there's a 4% rule of investing. You got this idea that if I set up an investment portfolio and if I take 4% of the value out each year and I increase it for inflation, I can do that, using historical returns and looking at, how I invest the portfolio and how I diversify. You can do that and not run out of money based on a lot of the research that's out there. Okay, so that's what the research says. Let's look. I'm going to take a quick break, and I'm going to come back. And I want to actually look at what, Dalbar actually does research on investor behavior and actual returns as they estimate them using asset allocation investing in stocks, bonds, and cash. And what we did this week here in the office, I had Scott actually do this work for me, but I actually gave him the data that Dalbar actually surmised regarding actual returns of investors in asset allocation funds, going back to the year 2000. Because I've actually talked about in videos and workshops that I've done, what happens if you follow the research on how to take an income from a portfolio. And the point that I've made is not only were you able to take the income and increase the income for inflation, but you ended up at the end of 2024 with more money than you started with if you followed the research. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.